Hey, this is Matt, and let's talk about the difference between stocks and bonds. With a stock, you are part owner of a company, and as such, you have a right to part of the assets and the earnings of that company. Whereas with a bond, you are a lender to that company or to that government entity. You are lending money for a certain amount of time in exchange for payment of a certain amount of interest on a regular interval. So with a bond, you are not owner of the company, you are a lender to the company. With a stock, you are an owner of the company. So as the owner of a company, your potential upside is unlimited. Your stock can go from whatever it is, $2 or $3 up to $100 to $1,000 over time. There really is no limit to it. Whereas with a bond, when you're just lending money, you're capped at whatever that bond rate is. You're not going to enjoy the growth of the company that you're lending to as a bondholder because you've already negotiated what you're going to get paid by that company, and there is no more upside beyond that. On the other hand, being a lender to the company as opposed to being the owner gives you some downside protection because as a lender, you are most likely going to get your money back. Even if the company goes belly up, they may have some assets, so you will get hopefully all your money back or at least a portion of it back. Whereas if you're an owner of that company and it goes under, it goes bankrupt, you may get nothing back as the owner. So bonds are less risky, but they are still risky. And obviously there's different ranges of risk depending on the bond. The risk of bonds really depends on who you're lending to. You can lend money to the US government, which is pretty much devoid of risk, but then your bond rate will be very low. As opposed to if you lend money to a municipality, let's say a city in your area, you may get a higher rate, and there are also tax benefits to that municipality and to the government bond issuance. If you lend money to companies directly, like any company on the S&P 500 or any growing company, obviously those bonds will pay a higher rate because there's more risk. And generally there's regular kind of corporate bonds, and then there's higher risk bonds that they call junk bonds for more risky companies. And the more risk a bond has, the more payment you should expect in return. So a regular corporate bond may pay you 5 or 6 or 7%. A junk bond may pay you 8, 9, 10 or even more percent depending on the risk that you are undertaking. But again, then you're getting into the fact that you're undertaking a risk with a junk bond that is way higher than just like a common stock in the S&P 500. So that bond may be returning 11, 12% a year, whereas the average stock on the S&P 500 may be returning 7 or 8% a year, but you're taking more risk on that bond. So bonds aren't always less risky than stocks. It depends on the bond that you buy. So let's just look at an object lesson here. Let's say you have $100 that you So let's do a quick object lesson. Let's say you have $100 and you have a choice between investing it in a stock or a bond. When you invest in a stock, you're a part owner of that company, right? And as such, that $100 in that stock, let's say the stock was issued at $100 per share, you buy one share and then you hold on to it for many years. And that share price may go up and down over the years, but hopefully it'll be a growth company and the value of that share will go from $100 to $300 to $500 or $1,000 or wherever. Let's say you decide not to buy a stock with your $100, but you decide to buy a bond. So you buy $100 worth of bonds from some company and they agree to pay you 5% per year simple interest on that $100 bond. So at the end of the year, they'll pay you $5 and the next year $5 for 5 years. So at the end of 5 years, you have $25 plus they will pay you your $100 back. So now it's just a waiting game. A year later, you get $5 back on your bond, whereas with your stock, it may have gone up or it may have gone down in value. We're not really sure. This is just arbitrary, but let's just say, oh, it's down to $50. Well, we got time, hopefully. You're in it for the long run on the stock. So you just want to keep holding that and hope that the stock goes up. So year 2 ends and you get another $5 paid to you on your bond if you bought the bond. On your stock, let's say, oh, it's up to $105. Well, 2 years later, your stock is worth $105. You've made $10 on your bond, so you're ahead on your bond over those 2 years. But again, hopefully with the stock, you're in it for the long haul, so you're willing to hold on to that, knowing that that stock is going to fluctuate up and down in value, but you still have your $100 vested and you're just going to keep that. One thing to keep in mind is these payments to you on your bond are subject to probably normal income tax rates, whereas your stock, holding it for the long term, is only subject to capital gains rate taxes, which are usually less than your income taxes. So even though the bond is paying you every year, you're going to pay a little bit more in taxes, and that tax is due every year when they pay you that $5. So as not to get redundant, let's just assume each year for 5 years you get that $5 and you get $25. And let's say at the end of that 5 years, your stock actually doubles in price to $200 and you decide to cash out. So at the end of 5 years, here you have a capital gain of $100, and here, pretend there's $5 bills there. I just ran out of $5 bills. You have $25 of a gain in bond payments. Now these are subject to personal income tax, whereas these are subject to capital gains tax, which is lower. So overall, in this case, this stock made you $100 over 5 years. This bond made you $25 over 5 years before taxes. The lower the risk, the lower money you'll probably make. The higher the risk, the bigger the payday, hopefully. So I read a statistic online, I don't know if I totally believe it, but it says since 1929, bonds generally have returned about 6% on an annual basis, whereas stocks were closer to 10%. That seems a little high when you factor in going all the way back to 1929. I don't know if it's really 10%, but let's just say maybe 7 to 8% is more realistic in the near future. So again, bonds and stock, they both have their place. Bonds, I would say, are more of an income play or a more conservative play. You just want to protect your original investment and make a little bit of money along the way or generate income from that bond, whereas stocks, you're looking for growth, and ideally you want to invest in stocks early on in life to take advantage of that growth, whereas with bonds, you're generating income and being a little bit more conservative but still getting a good return. And just as a side note, the 6% return on bonds and the 7 to 8 or 10% return on stocks is just sort of an average. Obviously, bonds have risk levels. Some bonds will pay less, some will be more. If you're investing in government bonds, the US government bonds, they're going to pay a lot less than corporate junk bonds. So again, this is just sort of an average of those ranges. And with the stocks, again, we're talking about overall stock market. We're not talking about individual stocks. Obviously, individual stocks can do much better than that or much worse than that. But if you're looking at, let's say, an S&P 500 index pool of stocks or an index fund, that's about the range you might see over time. So again, we're just talking averages here. I hope this video was helpful in discussing the difference between stocks and bonds. And if you like my videos, please subscribe. I'd appreciate it. Have a great day.